Well, good afternoon. Today is Thursday, May 15th, 2025. My name is Ward Keever, founder and CEO of Covenant Wealth Strategies. I'm joined by my coworker, Michelle Fisher, today. And this is our Stone Barn Speaker Series program, virtual programming. Today, we are very honored to have Lexi Stein with us from Columbia Threadneedle Investments, and I will introduce Lexi further in just a moment. Today's program is being recorded and will be posted to our covenantwealthstrategies.com website library for future reference. The title of today's program is Protect Yourself from Yourself, and it's on the topic of behavioral finance. And in light of some of the recent economic and market fluctuations, it just turns out the timing of this is perfect. And I think that you'll find it as fascinating as we find it to be, in addition to being a very timely topic and presentation. Let me share with you a little bit about Lexi. We've known Lexi for over 5 years. And she's been a tremendous resource to our team here at Covenant. Lexi is the regional advisor consultant in the independent advisor division of Columbia Threadneedle Investments. And she joined Columbia in 2016. She has a Bachelor of Science in Marketing and International Business from Penn State University. Go Lions, go Nittany Lions. In addition to that, some personal information. So we always have the corporate bio, and then we have things that aren't known in the corporate bio, things that aren't shared readily. But Lexi was born in New Jersey and grew up living part of her experience growing up in Japan. Before returning to the United States. She is the second oldest of 6 children. And in fact, her husband, Jake, also, does he still work at Columbia, Lexi?
No, not anymore, but
not anymore.
He
worked at Columbia when he proposed to you, because I remember the story of how he proposed to you up in New Hampshire and secretly had your entire family there when he was proposing to you. But Jake and Lexi are having their own family expansion project with their first baby due next month in June, a little girl, and they are still taking suggestions. So if you'd like to email in Michelle@covenantwealthstrategies.com, you can not only email your questions, but you can email suggestions for a little girl's name. Lexi and Jake are considering all options. So congratulations in advance. And we'll be praying for a smooth and successful delivery in June. So without further ado, Michelle and I will mute our audio and turn off our video so that the full focus is on Lexi and her presentation. But we'll be right here. And Lexi, as you're concluding your presentation, we'll be sure to jump back in. And in the meantime, if there are questions that come in, again, Michelle@covenantwealthstrategies.com. And we'll have some Q&A after your presentation. So, Lexi, take it away.
Thank you so much. I really appreciate the intro. You guys always do make it so personal, and I appreciate that. I love working with this team, so I really appreciate the opportunity to get in front of you guys virtually and talk about this topic that is extremely relevant, protect yourself from yourself. It really is a presentation, that's why we make emotional investment decisions, and how working with financial advisors, Covenant Wealth Strategies, how they can be that guardrail to make sure that we're not making any mistakes that could affect our goals in the long term. So us as humans, we tend to make mistakes. That's kind of par for the course, let's say. And when you're doing and investing, it makes it so much harder because it is so emotional. Finance is so emotional, it's makes it a lot difficult. So if you take away any number, 3.23, what is this number? Well, this is the difference between an average investor versus the market or doing it with a financial advisor. What this number really comes out to is that if you had a 10-year period and you started with $100,000, you would make $82,466 less doing it alone versus doing it with a financial advisor. And the reason behind that is really because we have a lot of these behaviors that we can't always control. Everyone has these biases internally. And I think, people often like learning more about themselves. And there's two different parts of behavioral biases that we're going to talk about today. So during this presentation, I'm going to go over kind of what that bias is, how it could potentially affect you in real life, and then how it could translate and affect you from a financial standpoint. And there's two different types of behavioral biases that we experience. Some are emotional, like overconfidence or loss aversion, and some are more cognitive. And that's kind of how we perceive events and facts and other things that have really shaped our beliefs. Those are things like anchoring, pattern-seeking behavior, representativeness, recency bias, those types of things. So that's kind of the agenda that we're going to go through today, and really just explore ourselves and kind of where we might be at fault at times of being guilty of some of these biases. So if we think about kind of just that impulse, it's part of our brain. It's called the amygdala. I'm not a scientist, but the amygdala is a part of the brain that kind of is you can't control some of these impulses. So let's say you have a child or a loved one and they don't know how to swim and they fall into the pool. Your instinct is to jump into the pool and help them. You're not, oh, let me get my watch off and my phone's in my pocket. I got to get my phone out. You're just jumping in. And sometimes that impulse can translate in a financial sense, or in other areas of our lives where we don't really want to, or we want to be able to control that a bit more and not necessarily make these mistakes that could affect our long-term outlooks, I guess, in certain ways. But sometimes you just can't help but react. So we're going to talk about how when you factor in the fact that you added money choices can be extremely emotional. Money, earning enough of it, having it, the potential possibility of losing it, it makes that code red a lot more difficult to control. Sometimes so highly so, because without it, food, your house, the life that you're able to live all really depends on money. And so research really suggests that our gut feeling and our default decision-making process heavily is influenced by emotions and our biases that sometimes really do override logic. You factor in the fact that, money and the fear of losing it, it really can get really difficult. So that's that number in the beginning of why doing this alone versus doing it with the financial advisor can be there could be such a difference. It's why a lot of advisors that I work with actually have their own financial advisors, because having someone as a barrier can be the difference between being able to really kind of get to your goals. So the first bias that we're going to go over is overconfidence. So let's start with overconfidence. I think this is one of the easier ones. It's a form of self-deception. And what I mean by that is people tend to have a tendency to maybe overestimate or feel a little overconfident with some of their skills, especially if they do it all the time. So usually if I'm in a room, I say, hey, everybody, raise your hand if you would consider yourself an above average driver. And 73% of people characterize their driving skills as above average, on average. In the room, most people are like, oh yeah, I'm a good driver. But if any of us have taken a statistic class, we know that a third are above average. So a third are right about that. A third are average, and 1/3 of us are unfortunately below average. I might be guilty of being one of those, but people do tend to overestimate their skills, especially when there's pride and ego involved. So I think it's one of those funny things where, especially when you have more information and you do it a lot more, maybe you think that you're really, really good at that skill or that thing that we're asking you about. So this is another example of overconfidence. Basically, what this experiment did was there was a horse race, and there were a couple of different people that would bet on the horse races, bookmakers, bookkeepers, whatever you want to call them. Each horse better was given a different increment of information. So like one guy got 5 pieces of information on past horse races. One gal got 10 pieces of information on past horse races. Somebody got 20, somebody got 40. And what they said was, okay, guess who's going to win the race, or what are your predictions? And then say how confident you are with your prediction. So the person that only had 5 pieces of information on past horse races, they weren't very confident with their guesses, right? The guy with 10 was a little bit more confident. I have more information. I can guess a little bit better of who's going to win. The guy with 20, of course, got a little bit more confident because they had more information. They felt more secure with their guesses. But what we found in this study was at a certain point, too much information actually negatively affected how good their guesses were. So their accuracy actually dropped because they had information overload, which I think is super interesting, because if you think about it from like a finance standpoint, 20 years ago, 30 years ago, if people had access to the Wall Street Journal, right? They had a newspaper, maybe they had one form of information that they would get their data from a financial standpoint, from an investing standpoint. And now we have 24-hour news segments. We have push notifications on our phones. We have neighbors telling us their opinions. It's a lot. It's information overload. And so because there's so much information, or the access to all this information is so readily available, people can feel a bit more confident in the decisions that they're making from a financial standpoint, or the bets that they're making from which stocks are going to beat the bench, or what's going to be the next big winner, because they have a lot more information. But like I said, sometimes too much information can be a detriment, can actually affect negatively how successful you are from an investing standpoint. And a lot of times, more information doesn't necessarily mean better, because maybe not all that information applies to you personally. You know, something really great about working with Covenant Wealth is that they can say, hey, this doesn't necessarily apply to your specific situation. We're focused more on these stats, or this is why we have put you in this model. So you can feel more confident that not only are you getting the right information, but you're getting the information that applies most to you and your specific situation. So that's, I think, another whole reason why I think it's making investing even more difficult these days, is because there's so much happening. Now, there is something called the confidence gap in the United States, where women self-report. 34% of women, or American women, feel less confident than their male counterpart when it comes to investing, when it comes to finance. And it really has affected how many women have gotten involved in finance, or have financial advisors, or, just feel confident enough to get involved. And what they found was they did a study, and men trade their portfolios 45% more than women. And their results tend to be 1% less. Now, the reason I say this is not because women are great investors. We are, but it's one of those things where a lot of times men can be very competitive, or the information that they're getting, I want to beat my neighbor, or they have this great stock idea, or I want to trade this more, or I have more of these ideas, where women are kind of less involved. And it's actually helped us be more patient and kind of stick to the goals, rather than just trying to beat the bench or hit a home run or find a winner from a competitive standpoint. But regardless, working with financial advisors, what's key, and I'm really happy that more and more women are getting involved and getting financial advisors. so that they are getting involved in more of those opportunities that are appropriate for them, but they're still having that patience, and men are being, kept in line a little bit more with the guardrails, and they're saying, hey, we're sticking to this plan or this goal. Yeah, we can be tactical and we can be strategic with some of these more exciting opportunities, but they're not necessarily letting you go off the rails and have it be a detriment to your overall return from a year-to-year basis. So I'm happy to report women are getting more involved, though. Case in point. So the next bias we're going to talk about is aversion to loss. Now, overconfidence was pretty straightforward. Aversion to loss is a little bit trickier. And the reason it's tricky is because it's how we perceive and experience risk. Aversion to loss is how we perceive and experience risk. And what that means is people can feel the pain of loss 2 to 3 times more than the joy of gain, which can cause us to make certain decisions that aren't so great, but we'll get there. I'm going to give you 2 gain options, and then I'm going to give you 2 loss options. Now, if I was to do this in a room, I maybe would pick on Michelle or someone from the audience to participate with me. But basically, if I were to say, okay, I'm just going to automatically give you $500 automatically, or you can chance it, and there's a 50% chance of you getting nothing or a 50% chance of you getting $1,000. What would you, the audience member, what would you tend to do in this situation? Would you lock in that 500 or would you take the chance? Most people, majority of people will choose the guaranteed gain in this situation. They say, I'll just take the 500. That's most people. Now, if you're a little risky, you can chance it, but I'm saying the majority. Now, when it comes to a loss decision, if I said to you, okay, forget I give you $500, we're starting from even. I'm just going to take $500 from you, just take it from you, or you can chance it, and there's a chance that you won't, 50% chance that I won't take anything from you, or there's a 50% chance that you're going to lose $1,000. What do you think the majority of people tend to do? Most take the risk on the loss choice. And that really tells you that, when people are faced with negative outcomes, they tend to be a little bit more risk seeking than when faced with positive outcomes. And it all has to do with mentality, and that idea that people do feel that pain of loss so much more than that joy of gain. I would rather chance it and not lose anything, because the thought of losing that hurts so much more. And so that can be kind of scary in situations when people are faced with negative outcomes, and maybe they are a little bit more risk seeking than would be appropriate from a financial standpoint. So what we see is during different elections, we see a trend that during election periods that a lot of money gets pulled out because people are really nervous that there's going to be a loss. Now, historically, during election periods, regardless of the outcome, the market usually, most of the time, does really well. In 2016, we saw $24 billion get withdrawn. The market actually returned 3.7%, and then we saw all that money come back in, but they missed that outcome, or they missed that return. They missed that come up because they were scared and got out. Now, if you expand that even more, obviously people got really, really scared during COVID. $260 billion invested in money market funds came out of the market. People were so scared of losing their money that they took it out of the market. And the market returned 114%. And still people are still on the sidelines, a little nervous. We'll get to, recency bias. But the point is that a lot of times, because people are so nervous, maybe they don't stay involved, or they don't continue on their initial path or their initial plan. And that really can negatively affect your outcomes in the long term, or can really skew you from that goal that you are on track for. And that's kind of why that's such a bias that we feel, is it really is hard to stay invested when things feel a little wonky. Now, I also want to mention, and I think this also has to do a little bit with overconfidence, is the domino effect of social media. People don't always realize this, but the algorithm that is now encompassing all of our phones and everything, and computers and Facebook and whatever you use, there's an algorithm that feeds you more of what you like. So if you click on a article that says everything's going to, blow up in 20 minutes, or it's time to buy, or whatever you're clicking on, the algorithm feeds you similar articles on that path. So now you're only getting one side of the story, which is why it's so important to work with Covenant Wealth, where they say, okay, yeah, I see that. I understand your fears, or I understand where your confidence is coming from, but let's look at it from this standpoint, or let's take into the facts of these types of articles, or these kinds of things that our systems are showing us, our disciplines are showing us. Instead of just getting one side or a bias towards one side of the media, because the algorithm really does feed you whatever it is that you are clicking on. So they're listening, but one more thing to keep that's just fueling those biases that are within us. So the next bias is anchoring. And anchoring is another, I think it's more cognitive, where you're kind of having a belief based on information, and it influences how we make decisions. That's kind of the biggest thing. Is the word anchor refers to the tendency to kind of latch on to or hold on to what's comfortable or what makes sense to us. And we allow that to influence our decision, even if it doesn't have anything to do with anything. An anchor can be a good anchor, or an anchor can be a non-point. So in this example, we look at two houses in New York. They're the same. Let's pretend they're the exact same house on the exact same street. They were built at the exact same time, and they come on the market at the exact time. And both of them are list price for $1 million. And both of them have an offer of 900K. Now, if I didn't tell you anything else about these two houses, and I said, which seller do you think is more likely to accept the offer? I don't know. There's not much to anchor towards from an information standpoint to help you make a decision. Now, if I gave you the information of this house or seller A, the house was purchased 15 years ago for 300K, and seller B purchased it 2 years ago for 1.2 million. You could use that information as an anchor to assume that seller A is more likely to accept that offer. But in reality, we still don't know. We still don't know this actual situation and whether or not seller A or seller B will accept. We're just using that information as an anchor to make a decision, or to have a certain belief that seller A would more likely accept it. So that's an anchor that would make sense. Now, an anchor that affects people in finance is like a home country bias anchor. Anchoring really happens in investing all the time, because we make decisions based on kind of familiar associations, things that we're regularly interact with. So when you're thinking about investing, a lot of times you'll invest in companies that you've heard of or you've used, or things that are in your house, or places you've been, or things that you're comfortable with. From a home country bias, that's something that happens a lot with anchoring. Now, if we look just from a diversification standpoint, I know Covenant really is so passionate about, these comprehensive plannings and making sure that you're very diversified. A lot of opportunities are in emerging markets, international opportunities. Over 50% of the world's population lives in that little circle right there. And what's interesting is that that's a lot of opportunity. That's a lot of, consumer strength, potentially, areas with growth. And while this international investing or emerging market investing may not be suitable for everyone, at least if you're working with a financial advisor, they can steer you in that direction, or they can have the confidence of which of those opportunities are appropriate for you. Whereas if you're doing it alone, the thought of going somewhere where maybe you don't know the company very well, or it's a different language, or it's a different system, or you're just not as comfortable with it because you don't know it personally. That's kind of how anchoring could be a negative or detriment to investing when it comes to using that bias as of an anchor. Cool. So the next bias is my personal favorite. Pattern seeking behavior is kind of the tendency of people to really look for, the human brain loves to seek out patterns in life. Our brains love patterns. And it's really funny because a really good example of pattern seeking behavior is at a casino. And I'm sure a lot of you have been to a casino before. There's a game there that's called roulette. And roulette, we'll just say for lack of a better explanation, is pretty much a 50-50 chance game. Red, black, even, odd. I know the 0 and 00 do put it in the casino's favor, but for this argument, let's say 50-50 shot. So you walk up to the table, you bet on red, you bet on black, and it's a 50-50 shot. And what the casinos did that was pretty interesting was they started putting up these signs that showed the last 10 to 15 rolls. And, the casino goers would walk by and they would look at the board and they would see that the last couple rolls were red or black. Last 10 rolls were black. And they decided in their head that, oh, the next one has to be red. Oh, it's red's turn to come. It's been all black. The next one has to be red. So they would make a bigger bet, or they would bet more confidently because of pattern seeking. But they forget that it's still 50-50 shot, actually not even because of the 0 and 00. But conversely, it's kind of one of those things where, if they see red, red, black, red, red, the next one has to be black. So it really can be a behavior that casinos were taking advantage of because they knew people were going to be pattern seeking and making these decisions. So I always like that example. I think it's funny because I do tend to see myself making that decision. Now, I don't know why this one didn't load, or this one loaded fully, so we can't play my favorite game. But where pattern seeking has really affected investors is when trying to guess or pattern seek, predict where rates were going to go. So from the 70s to the 80s, rates went up from 8% to 15.8. And then from the 80s to the 90s, they went down again. And what do you think investors did? They're pattern seeking. They're like, oh, rates are going to go up again. Great. So everyone thought they were going to go up, but they went down. Okay, that was just an extension. They'll go up now. And so they would guess that they're going to go up, but instead they went down. And they kept going down, and they went down and down and down and down and down. And okay, more recently they have gone up. But the whole point was people were just so focused on pattern seeking that they were making decisions based on the fact that they thought rates were going to go up, and not just investing or keeping things invested or staying the plan. And what happened was the fixed income results for these investors they took a hit. And what we saw was the average investor, actually had a negative return after 20 years, negative 0.29, versus just the bond market, if you just stayed invested, at 3.10. People were so focused in on trying to figure out where the rates were going to go instead of just riding the wave, or letting it happen. Now, that's kind of another reason why, you're protecting yourself from yourself, because a lot of times, like I said, it's really hard to control these biases. It's why we work with financial advisors, because it's not necessarily about predicting what's going to happen. It's making sure that you're invested for the appropriate thing that's for you, especially from a fixed income standpoint. So I think that the pattern seeking conversation can be interesting. No one has the crystal ball, right? There's a lot of things happening. There's a lot of moving parts. So making sure that you're not trying to look for patterns or areas where you're trying, you see, oh, it went up and down and then up, oh, it's going to go down. That's really where I think you can get yourself into trouble. So the next bias that we're going to talk about, part of the cognitive behaviors, is representativeness. And representativeness is really about, it's kind of similar to anchoring, where based on specific information that's represented to you, you make a decision. So what's going to happen is I'm going to give you some information about Susan, and you're going to tell me which is most probable, A, B, or C, based on the information I tell you about Susan. Susan is quiet. She's scholarly. She's passionate about social issues. She graduated from Stanford with a English Lit major and an environmental studies minor. What's most probable? A, Susan's a librarian. B, Susan's a librarian and a member of an environmental organization. Or C, Susan works in the banking industry. Now, if I do this in a room, like I said, I'd make everyone raise their hands, and which people love. And a third of subjects usually choose A. 2/3 of people usually choose B, which leaves 1% for the correct answer, which is C. Now, remember, this involves, I mean, I said it a couple times, so I wasn't trying to trick you too much, but I said which is most probable. There are nearly 2 million people who work in the banking industry and less than 200,000 people that work as librarians. Now, factor a librarian and a member of an environmental studies, that probability drops even more. Now, I did do this presentation a couple weeks ago, and there was a lady named Susan who was a librarian in environmental studies. So it's not impossible, but from a probability standpoint, Susan would most likely, it's most probable that she would work as in the banking industry. But I was trying to trick you. It was what was represented. And that can be what's difficult about investing, is that you don't always get all the information, or you don't know all of what's being represented to you is if it's all of the information. A couple years ago, there was a household name, and you bought all the products, very familiar with it. From the outside, it looked like a really solid company. Now, if you weren't an analyst, if you weren't in finance, if you weren't looking under the hood, you wouldn't have known that they were having managerial problems. Their balance sheet wasn't looking too hot. They didn't have free cash flow, or they didn't have, really solid management teams, or there's problems underneath the hood. And that's what can be problematic, and that's what can be hard about investing, is that it can be a company that you, from a representativeness standpoint, are very confident about. But when it comes to looking under the hood, maybe you don't know all the ins and outs about that company and whether or not that's a good investment specifically for you. So that's why it's so important to work with the advisors at Covenant Wealth, because they can really say, hey, no, I know that company it seems to be good, but when I'm looking under the hood, it actually is a little bit riskier. Or I know this company isn't too familiar to you yet, but we think it's really promising. The AI boom is really going to benefit them, XYZ. We really have to be careful with what information is represented to us, and if it's the whole story, and not letting what is represented be the one and only thing that is the decision maker, or is why we do something. Okay, I think we're almost to the end. Recency bias. So I think I mentioned recency bias in the beginning about how much money we saw that came out during COVID, and how a lot of that hasn't come back in because people were really scared. 2022 wasn't a great year, blah, blah, blah. So there is still some people on the sidelines that are saying, hey, I got hit kind of hard. I don't know if this is right for me. Recency bias is the tendency for people to focus on what happened most recently. Think about like from if you're working, think about like kind of an employee review. When my boss asks me to fill out my performance review, I remember the things I did last week, last month, maybe. I don't remember what I did in the beginning of the year. In college, I hated when they did the exams that covered the entire semester instead of the last part. I don't remember what we learned in the beginning of the year. What are you talking about? This recency bias can be really detrimental from a bias standpoint because sometimes we don't necessarily won't get involved or won't make a decision because we're scared of what just happened or we that what event most recently happened is affecting our decision making now. So when you look at it from a financial standpoint, 2008 was scary. Definitely was scary. 2008 crisis. So what we saw was what this chart is showing, the green is the return. So the market was doing pretty good. The red bars are the flows of money coming in. So even though the market was improving and doing good, people were not getting invested. People weren't getting back into the markets because they were so scared of what just happened and they just were not interested in possibly losing. Remember, pain of loss, really scary. They just couldn't get 2008 out of their minds and it caused them to not reinvest or get back involved. So that's kind of why it's important to work with someone that says, no, 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 I know that was scary, but we're seeing a lot of improvements. Fundamentals look good. These companies are solid. These are focused on downside protection. These are the ones that are appropriate for you. Because this investment cycle that we go through in investing, this is one psychiatrist's illustration on the investment cycle, how psychologically it can feel investing. Most people get out during fear and panic. And if you get out during fear and panic, you don't get to go back up to the fun stuff, to the confidence and when things are good again. So having that financial advisor make sure that you're not having recency bias affect you from doing future investments or getting involved again or for staying on the sidelines, making sure that you're in the right stuff so that you're comfortable and that you can experience the right kind of emotional roller coaster that can be handled. The problem when people get out during fear and panic is that when that roller coaster starts up again, that's usually when the best results happen. So biggest gains are early in a bull market. In the first third of a bull market, you're going to see the biggest gains. Now, that's usually when people wait to get in. And then by that time, hey, you still get the second and third. Good job, you got in. But you missed the biggest gains. It's kind of that whole idea of buy low, sell high. It's really difficult to do. It's really hard to do. And it's so funny because I feel like finance is one of the only places where your favorite sweater, if your favorite sweater went on sale, yeah, my favorite sweater, I'm going to buy 15 of them. What are you talking about? No one goes up to the cash register and they're like, hey, can you let me know when this is 15% more expensive or when it's gone back to normal price? It's your favorite sweater. And so in finance, when you think about your favorite stock or your favorite portfolio or your favorite advisor is telling you that things are on sale, it's really hard because you don't necessarily know if it's a good time to get in. But that's what's so hard about it, buying low and then selling when it's up. And if you're not involved, if you don't stay the course, if you don't get in early, then you potentially could miss out on the best results. And that's where we see an average investor returns versus what the market does by just riding that wave and staying invested, why there's such a differential between the results. So an average investor versus the market or someone that's working with a financial advisor that's been that guardrail, you can see the average results are very different and can be really negative at some points too. That's that number I said in the beginning, that 3% number, doing it alone versus doing it with a financial advisor. Because these people, all of those biases that we just talked about, they don't have someone explaining or making sure that they're staying the course or being that guardrail to make sure that they're not derailing at any point and making decisions that are going to negatively affect their overall goals. Now, financial advisors, I keep saying that word, but they're really financial planners, right? Covenant Wealth, they're comprehensive planners. They are focused on your goals for the future. They're focused on diversification. They're focused on long-term investing. They're helping you through up and down markets. Those are things that I think people expect, but people nowadays expect even more. They need someone that's going to be tax aware, help out with tax loss harvesting, or what tax implications there might be if you want to take out some money, what that's going to mean, or just emotional objectivity. I feel like advisors sometimes can be that therapist for some of their clients too, making sure that they understand and that they're comfortable with the decisions that you guys are making. Education and guidance. I think people want to understand and want to really learn about the investments that they're getting into so that they can feel confident and really understand how these are going to get to the goals in the future. So a lot more is expected from these financial planners than they were even 10 years ago. So, that's why it's so important to work with financial advisors, because it's not just picking the stock that's going to win. It's making sure that you get to your goals. And the investor's chief problem, and even her worst enemy, is likely to be herself or himself. That's a great quote. I love that. And I just want to make sure that I'm putting up again that any questions can go to Michelle. But I really appreciate the time today. I hope you guys learned something. I hope you feel a little bit, I guess, more understood during these volatile times. But I'll pass it over to you guys. And if you have any questions, if any questions came in, or if there's anything else that I can address. But thank you so much. I really do appreciate the time.
Lexi, thanks so much for your presentation. We always learn when we enjoy your presentations. We did have a few comments that were made. One was a suggestion for your little girl that you should name her Michelle. I thought that was entirely fitting and appropriate. So I just wanted to offer that.
So unique. So unique. Where did you come up with that?
Well, it wasn't per se us. It was suggested, but I thought it was a good suggestion. So just wanted to offer that to you.
Put it on the
list. So we did have a few questions, and then also I had made a couple of notes while we were going through this. So one question that came in, you were talking about per se biases, or let's see here. You were talking about, so pattern seeking bias, representativeness bias, recency bias. A question that came in, is that per se all of them, or are there other biases that you did not cover in your presentation?
Yeah, I mean, if I covered all the biases that could be affecting us emotionally, I think this would be like a 4 hour. It would be a class. It would be a college course.
Okay, so there are others.
There are definitely other ones. One that I often find to be true, or more recently what I come up against, is the bias of fear of missing out, or FOMO. I think that's a newer word. I think people sometimes have this fear of missing out that may be a bias to get them more involved, or involved in maybe a riskier play than what's maybe most important, or what would have been the initial plan. So I think there more and more, as more people get involved and as our world evolves, we definitely see more biases that could affect your overall goals for sure.
It's interesting how fear is such a motivator, because on the downside, when the market is moving down, people fear loss, and that's why they tend to go to cash. But then on the upside, when the market's moving up, people fear missing out, which might also be known as greed. And that's why they, per se, chase the hot stock.
Absolutely.
Right?
Absolutely.
So whether up or down, fear is a motivator. It's not necessarily a good motivator, but it certainly is an emotional motivator that factors in. Your
Definitely.
screen, the slide I think just before this was a quote from Benjamin Graham, father of modern security analysis. And it's interesting because I believe that Warren Buffett was a disciple of Benjamin Graham. And of course, Warren Buffett's now, what, 93, 94 years old. And so that tells you how old or how long ago Benjamin Graham was, right? But some of the things that Benjamin Graham talks about, some of the things that Warren Buffett talks about is patience. And I guess when you live to be 94 years old, you can have a lot of patience, right? But more and more of us may turn out living to 94 than you realize. But patience is kind of opposite of fear. Like when you have fear, you're seeking to act with urgency. Whereas when you have patience, you're not fearful. You're allowing things to happen patiently, looking for your opportunity.
And I think that's why it can be so difficult because, that's what they say, patience is a virtue. It's not
Yeah.
easily attainable.
I think another antidote, if you will, for fear is time. And what do I mean by that is, if there's a fear of loss, fear of risk of loss, when the markets are moving down, generally speaking, if given adequate time, the risk of loss is diminished, right? And so that's where I think, you've mentioned, and thank you, by the way, very much for the plugs of working with an advisor and specifically working with our amazing team here at Covenant Wealth Strategies. But we really focus our clients on their investment time horizon. And we are hopefully well known for telling our clients that if you have money that you know you're going to need in the next 6 to 12 or even 24 months, that money shouldn't be invested. It shouldn't be in the markets. It should be in cash or bank products or that sort of thing, because we don't want to expose that money to volatility. But if you have a time frame that's longer than, say, 12 or 24 months, if you have a time frame that's 5 years or 10 years, then to be able to put together an investment portfolio that's appropriate from a risk standpoint. And it's actually fascinating to just think back over the course of the last 5 years. What has happened in the last 5 years? Well, let's see. We had a global pandemic 5 years ago, right? And that was pretty crazy, and that was pretty scary, and there was a lot of fear. And I think you mentioned that in your presentation in terms of COVID and how many, per se, hundreds of billions of dollars was pulled out and invested in money market funds or bank products. So there's fear, but that was 5 years ago. And then we've also had 2022, where the markets were down. The S&P was down 22% in 2022. It was the worst year in recorded history for a 60-40 stock to bond portfolio, because what caused stocks to go down was rising interest rates, which also caused bonds to go down. And so interest rates went up and both stocks and bonds went down, and there were headline after headline about, is 60-40 dead? Like 60-40 is supposed to be a pretty conservative portfolio. It's what's used by fiduciaries. The prudent man rule or the prudent investor rule is typically 60-40. And after 2022, and even still today, there are debates as to whether or not, quote unquote, 60-40 is dead. And now, just in the last 90 days, we had these tariffs. And, I personally still don't know if I'm coming or going in terms of like, what are some of these tariffs and what are they at and did they change and what, right? But I mean, but each of these things, we saw the markets go down. Back in the COVID situation, you had a bear market, the market was down more than 20%. In 2022, you had a bear market, the market was down more than 20%. So far this year, we've avoided a bear market. The S&P only went down 19.5%. We were that close to a bear market, but we didn't get it, right? But my point is that if you look back over the course of the past 5 years, we've had some crazy stuff happen. And where we sit today is about 5% away from the all-time highs that we experienced back in February. Absolutely. And so I'm sharing this as an illustration to demonstrate my point that the antidote for volatility is time.
Yeah.
And if you have a time frame that's long enough, then this short-term volatility shouldn't be disruptive to your overall investment plan and financial plan. But again, as you stated earlier in your presentation, there's headlines. We used to just have the Wall Street Journal. Now you've got 24/7. And there's so much information that it's information overload. And a lot of times people think that they should be responding and reacting to each and every headline that they, and by the way, with the current administration, you've got headlines and then you've got, per se, Twitter or X, right? I mean, it's just like every 30 minutes, there's a new piece of information coming out, but we don't have to respond to each and every piece of information. We don't have to respond to each and every headline. And in fact, if you just did a Rip Van Winkle and went to sleep for the last 90 days, and I think they actually, don't they, isn't there something out there right now where they took people and they isolated them for 90 days and then they're giving them headlines and trying and having the people guess whether or not the headlines are true or just made up? I would lose that game right now because the headlines of the last 90 days, they're pretty crazy.
Absolutely. There's just a lot of noise, but that doesn't mean it's a signal to do something. I feel like there's a lot of charts that show historical long-term performance, and
Yeah.
not to spoil the ending, but the trajectory is up. And I think it's one of those things where if you do have the time, if you do have the patience, it's that whole idea of time in the market instead of trying to time the market. And that's what's so essential about investing and why it's so important to make sure that you have people that you're working with that can be those guardrails to make sure that you're not getting out at the exact wrong time and you're letting these things play out so that you can get the come up. That's inevitable. They're inevitably going to happen. So
yeah, I think it's interesting that 100% of the time, the broad markets have recovered from whatever loss had been experienced and have gone on to set new highs. And so if 100% of the time the markets have recovered and gone on to set new highs, then why are we having conversations about going to cash when the market goes down 10% or 15 or 20%? Certainly there have been individual companies that have not recovered, but when you're invested in a diversified portfolio, and we're talking about the broad markets, 100% of the time, the broad markets have recovered. So I think that to answer the question, why are we talking about going to cash, goes back to fear. Because people have experienced the sensation of loss, and that's maybe painful. And how do I make the pain stop? I don't want to experience any more loss. Go to cash, right?
That pain of loss, it hurts. So
that's where that fear factor comes into play, and it's exactly the wrong motivation, right? But the other thing, so I would say that based on the fact that the markets have always recovered and gone on to set new highs, I would draw two conclusions. Number one is that when the markets pull back, that's actually an excellent time to deploy any additional surplus cash that you have on the sidelines.
Things are on sale.
If the market's down 10%, you get a 10% sale. Doesn't mean it won't go to 20%, but you get a 10% sale. If it's down 20%, doesn't mean it won't go to 30%, but you get a 20% sale, okay? So it's just how much of a discount, how much of a sale you're willing to be satisfied with, even though it could have been that you could have gotten a little bit better sale. But they've always gone on to recover and set new highs. And the other thing that I would say is that if the market pulls back 10% and you're thinking about going to cash, or the market pulls back 15 or 20% and you're thinking about going to cash in your portfolios, maybe you don't actually have the risk tolerance that you thought that you had. Maybe you should reevaluate your risk tolerance and the level of risk that you're taking in your investment portfolio.
Absolutely.
And that's just like that's, I just think that's if the market pulls back 10% or 15 or 20% and you're thinking about going to cash, then that says to me, you didn't have the right time horizon. You didn't have the right risk tolerance. You weren't honest with yourself. You weren't honest with your advisor. Because if the market has 100% of the time recovered and gone on to set new highs, these pullbacks should be viewed as an opportunity, and not, our decisions should not be motivated by fear of loss.
Absolutely. Absolutely.
So-
Nailed it.
So there's a couple things that I would just say in conclusion. Again, I thought your presentation was fantastic. We vote for Michelle, so tell us what happens.
I'll keep you all posted, but thank you. I appreciate it so much. And I appreciate the opportunity for to be in front and talk to your clients. So thank you so much.
And if any of those listening currently or those who will listen in the future, as we have recorded this and we'll post it to the website, if you have additional questions, you can email Michelle at Covenant Wealth Strategies or your advisor here at Covenant. We'd be happy to answer questions. And if we need to, we'll loop Lexi in. And well, if the question is specifically for Lexi, we'll be sure to get an answer for you.
And I think, Lexi, if you wouldn't mind just pulling up the last slide with our disclosures, that would be great.
Michelle keeps us out of jail from a compliance standpoint. She makes sure that we always do the compliance thing.
Already showing the disclosures.
Alrighty. Well, folks, we are so glad that you are with us this afternoon. We hope that this has been time well invested, and we hope that it was helpful and educative and informative. Again, if you have questions, please reach out to us. Lexi Stein, thank you so much, and prayers and best wishes for you and your new family expansion project. We'll talk to you soon.
Thank you so much. I'll talk to you guys soon. Thank you.